Good news is rates have kind of ticked back down slightly and slowly. The Japan equivalent of the 10-year has risen to a point since highest since 2008. So we could see that kind of move and groove our economy a little bit. If unemployment got over 5%, we might see pressure on the Fed to really make a cut and make a difference to get people a little bit more affordability.
I'm Karl Kyler, your San Diego Realtor, and I'm back with Matt.Kish to give us a full update on what's going on with mortgage rates. We had the government shutdown. We have some adjustments there, and then we also had new forecasts from some of the major, let's say, banks or lending institutions out there that are kind of adjusting their expectations on where rates are going to settle. So we're going to dive into all of that today with Matt.Kish. Matt.Kish, welcome back.
Thanks for having me. Always stoked. 2 weeks, man. Time flies. It's so crazy. We're pushing into October, but here we are, man. Let's get them updated.
Yeah, let's do so. So let's jump into it. Where are rates right now with the government shutdown?
Good news is rates have kind of ticked back down slightly and slowly since the government shutdown and since the Fed rate cut, and since we last talked. Last time we spoke, the rates had kind of ticked their way back up after the Fed had done their rate cut and new expectations were laid out there, right? Because as we talked about and as we know, these interest rates kind of follow expectations in the markets, in politics, in world economies, right? And so now that we gained all that momentum in the summer, awaiting this Fed cut, all those the new rate was kind of baked into that period of time. And then when the rate did get cut by the Fed, now we have to set a whole new path, a whole new set of expectations going forward. Rates kind of went up then. They've gradually, slowly ticked their way back down. But the last few days, they've kind of remained flat. Not much up, not much down, especially since the shutdown happened, remained pretty flat.
So overall, the government shutdown had pretty minimal, like maybe a slight impact at first, but then once the water's kind of settled, we're kind of right back to where we were before the shutdown.
Correct. Pre-shutdown, they had ticked up about a quarter to 3/8 since the Fed did make their cut. Since they've kind of trickled down an eighth maybe here or there, but the last few days, especially market open this morning, remains flat. So hoping for some good news for us, right? Good news for us means maybe a weak jobs report, maybe some other indicators out there that the pendulum would sway and the interest rates would get a little bit lower. Nothing out there as of yet, especially with the government shutdown. We're not going to get reports like the BLS jobs reports that really swayed the pendulum, as you know, the last 12 months with these reports and with these markets, these inflated jobs numbers, raising the yields up and then coming in to revise these numbers, pushing the yields down, and the accordion that provided us for these last 12 months has really been a grind. So without that report, again, I foresee it remaining pretty flat, because what are we really going to use other than possibly world markets? And as we saw recently, Japan just got a new prime minister, and they're in the new prime minister's kind of policy and monetarily way of doing things is going possibly with a stimulus, and their economy is kind of showing that as possible inflation indicators. So the Japan equivalent of the 10-year has risen to a point since highest since 2008. So we could see that kind of move and groove our economy a little bit. So again, without anything and any reports going on in this country, we might have to kind of sway on world economies as well. So nothing really moving and grooving in our sector. But again, if world economies and something across the globe happens, we might follow suit as well.
So it sounds like everyone's just pretty much on standby due to the lack of data that's not coming in, or I shouldn't say the lack of data, but the data that's just not being reported or continuing to like feed the news and whatnot. What are your expectations if there is an impact on rates? What would your expectations be that impact would be once the government shutdown comes to an end?
Well, once the government shutdown comes to an end, again, we were on a good little trend. We were on good trajectory, and then the Fed did their thing and lowered their interest rate, their Fed funds rate, and we saw interest rates kind of get pushed back up. But again, they've kind of tempered back down. But I see this kind of where we're living until the end of the year. There might be again some slow little valleys and some slow little peaks, but I really don't see a big sway one way or the other. I don't really see a big push of interest rates getting crazy high unless, again, there's a war, there's something that happens that's unforeseen. But I really don't see a push towards 5%, and I really don't see a big jump towards 7%, right? So I think this is kind of where we're living until first quarter of 26.
My gut tells me the same thing. If the markets are unable to move now due to the lack of data to kind of tell us what's going on, the government shutdown comes to an end, then we still got to wait for more data to come in. And I think it's already expected that the labor reports aren't going to do as well. So to the severity or to the level at which they may not do as well as we'd hope is to be determined. But this is a really good segue. So you're kind of expecting rates to sit where they are until the end of the year, until Q1 of next year. Fannie Mae, one of the larger lending institutions out there, the government-backed lending institutions, just came out with an updated rate forecast, and they're expecting rates to be around 6.4 by the end of the year. And then you have, I think Wells Fargo estimated 6.3, and then you have the National Association of Realtors, which isn't a bank, and it's just interesting that they're even in this mix, but they're predicting 6.7 by the end of the year. What are your thoughts on these forecasts? Where do you think, what is it you think we're gonna land at? And then for someone like Wells Fargo or Fannie Mae, what do you think is driving their forecast in the direction that it is?
I'm gonna float on the side of Fannie Mae and Wells Fargo here, because we're already there, right? Just like we talked about in the previous question, this is kind of where I see rates living until the end of the year, Q1 of 26. So that's where we're at. We're at 6.3. We're at 6.4. For some people, it could be even lower. VA and FHA definitely lower into the fives right now, right? So we're already there. So I kind of seeing us hold tight. I don't really seeing us jump to the 6.7 again, unless something comes out that's unforeseen. There's a lot of politics and tumultuous stuff out there that is kind of a touch and go, day-to-day kind of thing. Thank goodness for checks and balances and things of that nature. But again, we see kind of the trend where that's going, and 6.3, 6.4 is a good little indicator, a good little spot on the map for us to go to. And I think we'll live right there, and I think that's kind of where we're at anyways. So I really don't see, again, other than maybe some minute valleys and some minute peaks, we're going to stay pretty flat, and flat is 6.3, 6.4. So I'm gonna give Fannie Mae the token there. And Fannie Mae is and Freddie Mac are the primary buyers of these mortgage-backed securities, of these mortgage bundles on the secondary market. And so Fannie Mae is going to have their finger on the pulse of these mortgages a lot more than most of these institutions.
Yeah, I agree. I always take Fannie Mae and Freddie Mac's rate forecast the most serious, just because they're the larger institutions out there, government-backed institutions. So they're, like you said, I think you said it best, their finger is directly on that pulse in the right spot. So to kind of have those predictions and more so just have the data to assess what's going on and everything, I think they're probably the most, they're the closest to being on point or the most accurate. That kind of leads me to wonder if we could, for just a quick second, what would need to happen for us to possibly tick down, and I don't want to say breaking 6%, but what would it take to get us to 6.1, 6.2 by the end of the year?
If unemployment got over 5%, we might see pressure on the Fed to really make a cut and make a difference, to get people a little bit more affordability. Because right now, that's the key. That's why people are still on the sidelines. There's so much pent up buying prospect on the sidelines right now, but nobody could get into anywhere because of affordability. And especially with a weaker labor market, and especially with the unknown out there in the politics, and especially without any policy that's been instilled, that's really going to keep us on the rails. People aren't going to really dive in and buy those big ticket items right now. There's not a lot of consumer confidence, and that's really big too. That's a big factor that I don't think a lot of people are talking about. Is rates. We've seen rates get lower. We've seen rates get lower to almost a full percent over the last 3 months, 4 months, right? So people were talking about, I'm waiting for rates, I'm waiting for rates, I'm waiting for rates. So rates happen, and people are still on the sidelines. So what is it? It's 100% affordability, and it's 100%, it's consumer confidence too. So those two wrapped in together, it's 100% gut punch, and people are still hurting for affordability, and they don't see the world in a place where they're confident to go out and put a lot of money into something.
Yeah, you're hitting this nail on the head on affordability. It's something that I talk about so regularly in my San Diego Market Matters videos that I post on almost every Sunday. And then at the end of the month, I do a national number review. And then at the beginning of the month, after the San Diego numbers report, I do a deep dive into how San Diego's doing. And I'm seeing our year to date and our month over month is still growing in price, median and average. We have some ups and downs. So I describe this regularly as more of a feeling like a neutral market, but overall year to date, we have positive growth. And the good thing, I think the best thing that's happened in the last 10 years is rates having gone up so aggressively, because it finally just put like a hard ceiling to this outrageous price growth. And hopefully it's allowing incomes to catch up. Now, I understand people are struggling out there, and the San Diego Humane Society right now is reporting that they have never had so many animals in their kennels. Like they're overstocked by older animals, and part of that, what I'm seeing is reported, is that a lot of people can't afford to even keep their animals anymore because it's just so tight. So hopefully we have rents that are stabilizing, we have prices that are stabilizing. Hopefully this will give time for unemployment to kind of restabilize, rates to come down. Hopefully mortgage rates will stay so that prices don't get out of control. Incomes will naturally, continue to grow or, increase a little bit over time, and people will get their breathing room back. So it just comes back to that big word, affordability. And I can't tell you the number of people I come across now regularly when I take an Uber, where Uber is the side hustle now. Often I used to find Uber drivers that just Ubered all day, all night, fucking 7 days a week, like crazy. Like, oh my God, I'm always impressed by those individuals because they'll drive for like 12 hours a day, 7 days a week or something. But I found people where they're like working a full-time job, and then they got a Tesla for, $220 lease or something like a really ridiculous payment. Then they charge it, which is minimal cost. And then they drive for an extra 20 to 30 hours a week just to stash extra cash on the side. So affordability. I think you're spot on. Well, we'll wrap it up there. There's your full update on what's happened with rates, where rates are, and where you can expect rates to kind of continue to go, most likely. Obviously, as Kish said, if we had an unexpected unemployment rate or an unexpected jobs report, that could impact rates, but the signs of that are not as highly likely. So we kind of know where rates are going to go. Kish, do you have any last thoughts or words you want to leave the audience?
Just go out, go talk to your neighbor. Tell them you love them.
That's good. I love that. As always, I'm Karl Kyler, your San Diego Realtor. We'll see you next video.